The opening bell rings on the second quarter of 2026, and two of Elon Musk's biggest companies are bleeding in the market. Tesla is sliding down 0.92%, while SpaceX is taking a significantly harder hit, dropping over 9%. But if you look at SpaceX's earnings report, the numbers were actually strong. The company beat expectations on both sales and profit. This wasn't a reaction to bad numbers. SpaceX stock had climbed 16% in the 2 days leading up to the report. This was a classic case of investors selling the news to take their profits. While the scale of the drop is different for each, both stocks are falling while the broader market climbs. Investors are increasingly viewing the two as a linked pair. To understand why these two distinct businesses are moving together, we have to look past the trading floor and at their massive capital expenditures. A look inside SpaceX's internal ledgers reveals a massive shift in where their cash is going. Last year, the company's capital expenditure for AI was $749 million. Last quarter, that figure spiked to $15.8 billion. That investment increased SpaceX's raw AI compute capacity from 0.4 gigawatts to 1.4. SpaceX is now renting that capacity out to outside AI labs while simultaneously developing its own internal models. This spending level has turned SpaceX into a major player in the AI infrastructure space, operating well beyond the bounds of traditional aerospace. Tesla is following a nearly identical strategy on the automotive side. This matrix shows Tesla doubling its prior year spending, putting $5.8 billion into new plants and equipment. Just like SpaceX, Tesla also doubled its own AI compute capacity in the first half of 2026. This hardware expansion is the foundation Tesla needs to train its proprietary self-driving systems. Wall Street is now pricing both companies as two halves of a shared AI hardware engine. Because the infrastructure is overlapping so heavily, some analysts believe a formal merger between Tesla and SpaceX is becoming a possibility. However, any such move faces a significant geopolitical hurdle: Tesla's deep ties to China. U.S. regulators are unlikely to favor a sensitive aerospace defense contractor like SpaceX merging with a company that has a significant physical and financial footprint in China. For a merger to move forward, Tesla would likely have to undergo a radical restructuring of its global operations to satisfy national security concerns. That's why Musk recently dismissed speculation that Tesla would sell off its China business. Giga Shanghai is a massive pillar of their global production. The financial data backs that up. China currently accounts for 20% of Tesla's annual sales. In July, sales there jumped 38% to over 93,000 vehicles, the 9th straight year of gains in that market. A formal merger is at least a year away, but the market is already treating them as a single bet. These are two companies, run by one CEO, building a shared future on AI hardware.